Well, if you're not looking at this change, if you don't want to be an upper quartile CFO, the average tenure of a private company CFO is 27 months.
Ouch.
So which quartile do you want to be in? Because your successor will look at change if you don't think you need to change.
I figured we'd do some Q&A with Gary and just have you guys have an opportunity to ask, inside a CFO's mind, some questions, things that are on your mind that go through your head in meetings, why CFOs do certain things, why they don't, what the reaction is, what's the best way to approach them, things of that nature. So, Gary, we had a quick conversation before we started about, I think the first thing we need to discuss, and I know we talked a little bit about on the podcast, is what is a CFO versus the controller versus the bookkeeper, so on and so forth, that finance person. What are the differences between the few?
Sure. So in privately held companies, non-publicly traded companies, you're generally going to have a controller up to about $25 or $30 million in revenue. And that controller is, for the most part, 80% of them are glorified accounting managers. They don't think like the owner. They don't think like the board of directors. They're worried about having enough cash to satisfy the bank, not thinking about how to finance and grow the business. And realistically, when you're trying to work with those companies, the controller is not going to be your friend. He doesn't think strategically. You move up the continuum, the CFO is going to be the chief financial officer, going to be thinking about how all the parts work together, how you manage risk, how you satisfy employees and control costs, and healthcare is a great example. And then finally, what you really want to get to, the top of the pinnacle, is what we call a CFO plus, or a CFO trusted advisor, where the owner or the CEO wants that CFO to walk in anytime with ideas, to brainstorm, to have a strong opinion.
So CFO, what category would you say, what size groups are they going to be on? Are they going to be on smaller groups, or this is just really going to be groups that are of a certain size or more?
Not necessarily. As you know, I mean, just for everybody on the phone, I am a CFO of an engineering company. I've started two groups of CFOs of peers. One had thousands of members 10 years ago. We started another one that has face-to-face meetings, and these are all private company CFOs. So to answer your question, I have companies with 20 employees, $20 million of revenue with a CFO. I also have companies with 5,000 employees with a CFO. So you're going to see small groups. You're going to see all the way up to.
Is it a revenue? Is it an employee life standpoint, or is it revenue based typically?
Revenue.
It's all revenue. Okay.
Well, it's mostly revenue.
Yeah.
Mostly revenue.
Because it just becomes a bigger revenue situation. They want to have somebody sharper in there, more strategic thinking.
Absolutely.
So would you say a CFO is forward thinking versus looking in the rearview mirror like the controller?
Half of the CFOs are. That's the challenge. Half the CFOs have a title of CFO, but they're really glorified, or just not even glorified controllers. In the sharp companies, in the good companies, even my small engineering company, we have a CFO and we have a controller. The controller manages the details. I manage the strategic thinking and the relationships and the best practices.
Okay.
That's not uncommon. At $25 million to have a controller and a CFO. You guys want to get to the CFO.
And I guess my next question would be is, we talk about, and we've had these conversations, that they pretend to be a CFO or their title is CFO. Does that mean they're a CFO, or is that just, it's a cool title? And, I think that's what I am, because in most cases they're that's the furthest thing they are from.
Amen. Absolutely right, John. Sometimes they're titled CFO to give the bank some semblance of capabilities, but they're really controllers. A lot of times the CFO is done to give them clout with the bank, and the CEO does that to put the CFO between him and the bank.
Gotcha. So we've got this whole COVID situation. what is the current state of the union? You manage a group, the CFO Solutions Group. What is the current state of mind right now? I know you did a Zoom meeting with them because you guys meet on a monthly basis, I think 9-10 times a year. What's going on in their mind right now? What's the state of the union?
Well, the state of the union is how do we reopen the business? How do we survive for 6 or 8 or 10, 12 weeks, whatever it's going to be? We've got people that have zero revenue for the last 2 months. The restaurant group is a great example. 2,500 employees, basically no revenue. He is struggling to satisfy the bank, the cash, his taxes, his mortgages. He is really concerned about that. Others are finding a way to qualify for certain relief funding, whether it's PPP or the EIDL or the ERC, a whole bunch of acronyms out there. And people are trying to stay on top of how do we qualify and receive that? And then how do we keep track of our costs and manage that cash so we can open up in 6 or 10 or 12 weeks? So it's a tough time right now for CFOs.
So it's top of mind is just, I guess the revenues are down overall and everybody's just trying to stay afloat and figure out how to reopen.
But let me add, they're also worried about the safety of their employees and their customers. So
in order to reopen, you mean?
In order to reopen, but a CFO manages revenue, but he also manages risk. So most people think they manage cost. They have to manage and be able to forecast revenue, but they also have to manage risk. Bringing employees back to an unsafe factory or a warehouse or an office setting is terrible. And good CFOs are worried about risk right now. As much as they're worried about cash, as much as they're worried about their customers coming back so they can collect their receivables, good CFOs are worried about employee safety, family safety.
Okay. And they're not interested. Are they not thinking about, we selfishly are thinking from a brokerage standpoint, all right, this is a good time. Come out of this. People are going to be looking to save money. We've got one of the biggest line items. Mm-hmm. We can get them to make changes. Or, is it on their mind right now? Is it kind of, and Paul will talk about it because he's been doing some calling and having some success with it, but it's more of planting a seed where they know they need to address it, but they're not going to address it right this second. Is that kind of what you think is happening out there?
I think they are thinking. I don't agree with that. To be honest, they're worried about how to bring their employees back, how to communicate to their employees that they care. Now is a perfect time to put a plan in that improves plan quality and reduces cost. So right now, a sharp broker is in touch with their clients, in touch with their prospects, trying to help them understand their cost for the next 8 or 12 weeks because of federal reimbursement under the PPP plan. Second point is if you're trying to create a prospect to a client, talk to them about not only can we save you costs, we can reduce your risk and improve your quality. And most brokers will never tell you that. An advisor will help you improve your plan quality, reduce risk, and reduce cost. That will get a CFO's attention to talk to a cold calling advisor.
I love how you say that. You said that earlier, cold calling. Well, you said advisor this time, at least. Usually you say cold calling broker, which I was for you. Yeah. But so just relay this story into more of managing risk versus saving money on healthcare, speaking to them more of, because they're handling the property and casualty insurance, right? So they understand managing risk from that standpoint, but not that it can be done on the healthcare side.
Exactly.
We got a question here. You say reduce risk. Can you dive into that more? What does that mean to you specifically?
Sure. We'll give it a shot. The risk we have right now, and let's just assume we all renew January 1st. So people are struggling to get through June, July, August, and in the back of their mind, they're saying, I'm probably looking at a double-digit healthcare premium surprise come December 1st for January. So the first thing I'd like to do is have a plan in place that not only can I reduce costs, but I can reduce my future surprises and my cost increases. So most people wouldn't even bring that topic up with the CFOs. And not only can we save you money now, the better you understand your cost and what drives your costs, we can help you lower or eliminate future increases. Stop the surprise. Everybody right now is worried about all kinds of testing costs and all kinds of other costs that are going to pop up and wind up with a real surprise in claims after being in the doldrums for a quarter.
And you mentioned in the past, are CFOs or accountants or whatever you want to call them right now, are they looking on a quarterly basis? Obviously, the industry, the economy has been great for a couple of years now, so they're probably, most companies, if they're smart, they're sitting on some surplus, they're sitting on some money. Those that I talked to, is that what's going on in their mind? Are they thinking, hey, I've already got money set aside, or we've done well, we're going to have a bad quarter, it's going to be okay? Or they frantic right now, most companies?
Most are frantic. If we knew it was a bad quarter, if we knew we were going to reopen July 1st and get back to full employment, nobody knows what's happening. You've got an election year, you've got a dysfunctional economy. It's different state by state, it's different internationally. So I would say CFOs are not worried about a bad quarter. They're worried about the R word coming up. Depending on the sector you're in, the R word is the recession word, okay, is scaring people.
Yeah, I mean, I think everybody's concerned about it, but the reality is we're going to have to wait and see. You've got the election coming up. I don't know how much that comes into play. I think things are going to be delayed. I think we had a conversation talking about it. It's like we're not feeling it right now so much in the insurance industry. I would say existing clients, new business has slowed down. My talks with a lot of other peers, same situation. But as this economy maybe swings back, we're going to have to wait and see, because the reality is 30-something million people are laid off. Are they going to come back? What's really going to happen? A lot of what's going on is speculation. Let me take some of these questions here. Let's see here. A question from David Johnson. What percentage of CFOs have HR flown up to them? What's the dynamic when HR is a roadblock to change on benefits?
Great question, David. In my CFO group, we run that survey all the time. And these are private company CFOs. 1/3 of us officially have HR reporting to us. And by the way, we have no training in HR, so that's a risk. But I guess we're better than the alternative. The surprising point is another third feel they're held accountable if HR screws up. So, we're responsible, but we're not responsible. We're accountable, but we're not responsible. And in some cases, we're accountable and responsible and can act accordingly. So if I break that into those buckets, the CFO who has HR officially reporting to him will be open to an intelligent call from an advisor. Okay? The one who has HR reporting to an HR manager or somebody else, the plant manager, an office manager, you've got to find a way to get around that HR person and go to the CFO. And don't even worry about hurting somebody's feelings in HR, because they're not making the cost decision anyway.
I think if you haven't listened to Gary's podcast, we did one of the first ones we shot. Go ahead and go back and listen to it. I think one of the best things that I got out of that podcast, and we always ask the question as consultants and advisors, we go, I just don't understand why the CFO is not involved and they're hiding from the healthcare budget, and they let HR handle it. And I think what we came up with is simply that you guys just have given up on it and think, well, what the hell? This thing's only going to keep going up. I can't do nothing to stop it. Let HR fall on the knife. I'm not going to take the blame for it. Just stick it on HR. And that makes 100% sense now to me as to why they just allow them to deal with it, because it's just a thorn in their side that continues to go up, and there's nothing we can do. And, let HR take the blame.
Well, let me jump on that, John, if I may. Keep in mind, HR, managers tend to be people. They tend to care. They tend to be compassionate. They don't mind people walking in their office talking about, what's going wrong and complaining about something that might be insurance coverage or claim coverage. CFOs do not want that person standing in their doorway Monday morning. We just do not want it. We're not cut that way. We're cold-hearted, analytical guys for the most part. And to get us to think and be responsible in HR, we push away the compassionate, empathetic part, and we want to deal with numbers and facts. So we are different. You know, we're different people than the HR managers, and you have to remember that when you're talking to them.
I would say you guys are a little bit more stern and colder. What do you say?
Cold-hearted and not nice people.
Yeah, I mean, we've had.
You mean personally?
Yeah, I mean, Gary is very different from most of the breeds. I mean, most of them are a little introverted. You know, even after your meeting, sometimes. I mean, I met the guys how many times, and they're still scared of you. Good idea. The best idea was we had that happy hour. If you guys can find ways to get them to the bar, a lot better chance of having a conversation with them, finding out who they are. They like to drink. A lot of people like to drink. So if you can get them in an avenue where it's less, intense as far as a sales perspective, give that a shot. Let's see. Take another question here. We got somebody who says, as you look back on working with different brokers, consultants over the years and have given you, all CFOs are getting called on almost daily. What are some of the moments that cause you to, one, take a meeting with a broker cold calling you? What did they say or ask that got your attention? And two, what do you hear most often that you dismiss, and what stands out that gets your attention?
Okay, a couple good questions there. Thank you. The first part is, remember, you're dealing with an analytical person who understands risk and understands costs and trends and understands comparative performance. So if you're going to call up, and I get these calls almost every day, and I'm an old school, I'll do gentleman in air quotes, that I answer my own phone. Nobody screens my calls. So if somebody calls me at 8:45 in the morning, I'm there. If somebody calls me at 5 o'clock, 6 o'clock, 7 o'clock, it goes to my cell phone. John will tell you, I answer my phone. And if you're going to tell me that, oh, you're up for renewal and we do things differently, and I ask them one thing, what do you do differently than every other broker? And you got 10 words to tell me, and they can't do it. So first of all, you better have a good elevator pitch, and you got 10 words to do it, because I will take the call. So first of all, I'm unusual that I take the call, and I give you 30 seconds to hang yourself or get an appointment. John called me 3 or 4 years ago, and immediately I knew he was analytical. He was talking about trends. He was talking about numbers. He didn't ask me how I felt. He didn't ask me about my senses. He didn't ask me if I was ready to change brokers or consider a change. He talked about how he's analytical. And it hit a nerve. And John will tell you, 8 days later, he was our broker. And I still like him. I still talk to him. And my employees like him and talk to him. So,
that's right.
Now, on the other point, I believe, what was the second part of the question, John?
Second part was, well, you kind of got, what do you hear most often that you dismiss, and what stands gets your attention? Well, you said
we're different.
What do you dismiss? Yeah.
Well, we're different. Tell me how you're different. And they can't. Okay.
Brett Morris says, my grocery clients are not complaining. I hear that. My dad's in the fruit business, and he's making money. Hey, guys, I got to apologize. I set this up as a webinar. I think I was supposed to do it as a Zoom meeting so everybody could be on, but I think I screwed it up. Normally, we do Facebook Lives every Thursday. If you guys aren't in the private Facebook group, make sure you join. We go live every Thursday, 8 p.m. Eastern, 5 p.m. Pacific. We also put it on the podcast and YouTube. Brett also says, some CEOs have told me that returning employees, returning revenue, new compliance is taking up all their time, and they will need to put looking at the insurance on hold. What would you say to a CEO to bring insurance and benefits higher on their priority list during this time?
I think I'd say it at any time. Right now it's acute, so I would suggest the following. Most of brokers, okay, not you guys, because you're smarter than that, or you wouldn't be working at 7 o'clock at night, are going to tell me you're different and you're going to provide service. I think the simple question is, could we meet, and I'll show you what best-in-class companies are seeing, what kind of increases or reductions they're seeing, and what kind of trends they're seeing. All I want to do is allow you to benchmark against comparable data. And frankly, it doesn't matter whether you're in the fruit business or the restaurant business or the engineering business. Companies in 50 to 100 lives, companies in this, and you guys determine what the sector is you're talking to. You know, best in class, they're seeing reductions followed by 1 or 2% annual increases, where the average is going up 6 or 7%. And I think you just stop the sentence there. Most of your brokers will say last year the market went up 8%, but we deserve to be your broker because you only went up 6%. We're 25% better than the rest of the herd. And stop comparing yourself to the herd. Compare yourself to the best in class. What are best in class companies doing? CFOs will respond to, we're competitive people. We want to be upper quartile.
You mentioned getting asking for a meeting with them. We're in this situation where even a guy like you at your age, I won't tell anybody your age here. You guys would be surprised to know Gary's age, and the guy's an absolute animal. He'll outwork everybody on this call. But now I lost my what I wanted to ask. God damn it.
How to get a meeting?
Oh, okay. So are you now open to Zoom meetings? Like, look, you're doing one now. You fought me in the past. I go, Gary, do some online stuff. You got the group, do it online. And now you're kind of starting to do it. Do you see that as something that, hey, I like this. I'm going to be more open to if somebody says, Gary, forget about a meeting. Let's just do a quick Zoom meeting. Give me 15, 20 minutes. I'll give you my spiel, and we'll start there. Are you going to be more open to that than,
yeah, I am.
Than the face-to-face meeting of getting stuck with somebody for a half hour?
Oh, I like the Zoom meetings now. I have converted. The interesting part is our CFO group still wants to have face-to-face, because when we bring in our subject matter expert speakers, the common feedback is great speaker, really knew their stuff, very helpful, but I learned as much from the people in the group in the interaction. And
yeah, I think we're
still an introverted society of CFOs. So we're not quite ready to go 100% Zoom, but I think I'm more extroverted than most CFOs. I'm open to Zoom. Everybody else is open to Zoom meetings now. And just tell them, I want 15 minutes. And all I'm going to show you is a comparison performance and, see if I can earn your business.
Yeah, I mean, I think from your standpoint with the group, I think it's very different, because it's like people are asking me about high stakes advising. Are you going to do it virtually and this and that? I'm like, no, it's worthless. The whole point of the event is the camaraderie, the peer-to-peer interactions, the networking. I mean, that's worth its weight in gold on top of what you're going to get at the event. You lose that in a virtual event. Now it's just something like this, where yes, you can get value, but it just takes away from it. So I think your CFOs are just saying to you, listen, we like, being around our peers and people we know. But when you're talking about a stranger and they're coming to your office, and now I got to talk to them, I got to worry about getting them out of my office. What if they're pushy? Well, on a call, it's like when your parents call you and, you want to get off the phone. They start giving you shit. You get off the phone. Mom, I got to go by, And I think that would be my mindset is, sure, I'm open to Zoom calls because I've done so many right now, talking to tax strategists, so on and so forth. It's just the lay of the land right now. But you look at SaaS companies, guys, SaaS companies, software as a system, Zoom, what we're on right now, making billions. 100% of sales are done over the phone, millions of dollars of sales. My brother works in Japan right now and works for, I think, AutoCAD. They do millions of dollars in sale, 100% on the phone from different countries, so on and so forth. So we're really the only ones stuck, back in time. Do I think a face-to-face meeting is better? Absolutely. But can you always get one? And we'll have Paul on to talk about that too in a minute. Actually, let me see if I can bring Paul on to chime in as he wants here. Paul, are you able to put your camera on? Let me know.
I can't do the camera, but I can unmute.
Okay. All right. Let me keep trying for you here.
But I got to tell you, I'm totally in agreement with everything so far.
Yeah, I mean, Zoom, so let's talk about Zoom meetings for a minute, Gary, because Paul had mentioned on the episode last week, basically about doing Zoom meetings with people and trying to set them up. So right now you're saying, hey, listen, if somebody's calling me, I'm open to a Zoom meeting.
Yes.
And what should that?
Let me interrupt, John. I would have 1 or 2 graphics, even if you can just hold them up and very simply, do you know what your PEPY is? And can I tell you what PEPY trends have done? And I can tell you what upper quartile PEPYs are. And then we show you trends. So I'd have two little boxes, little matrices, and just say, I know upper quartile PEPYs. And all due respect, Mr. CFO, you're not a snowflake. Your group is not that special. Good PEPYs are $8,000 to $10,000 per year. You're at 17,000 a year. There is, and my guess is you've been averaging, and you guys can do your homework, and you know what their 5,500 form says. You've been going up 6 to 8% per year. Where, let me show you this, upper quartile has been flat the last 3 years.
Is that what they're concerned with most cases? Are they concerned with what their peers are doing?
Yes.
Right. I mean, I guess it makes sense because in the advisor industry, it's everybody's competing in numbers, and I want to know what my peers are doing or what have you. So it's important.
The reality is most brokers are going to say the market's going up 8%. You should be damn glad that you only went up 6%. And there's no truth in that. The whole market can't go up 8 if all of their customers are going up 6. So it's like, your mileage may vary. Why do you have a window sticker on a new car? Because nobody pays it. So why would I ever believe a broker telling me the market's going up 8, but I get I'm so good, I get everybody 6%. CFOs get together. Where'd your medical go up? 6, 5, 0. What did I tell them? Down 25%. You're full of it. No, talk to John. Right?
Got it.
We want to be curve breakers. We want to be upper quartile.
So what is, I got a question here from Spencer. What is the CFO language they need to hear to engage and take the appointment, then move forward?
Okay, let me try doing that, Spencer. Again, let's use my example where the market's going up 8%. If we market it here, here, and here, we can probably bring in around 6. If it was me budgeting, I'd budget 6 or 7. Budget 7, we'll come in at 6. We'll make you a hero. We'll have another great renewal. What I would ask instead is, hey, Gary, what do your last 3 years look like? What's your current PEPY, and what are your increases been the last year? 6, 7.5, and back to 6. Would you be stunned if I told you upper quartile has been 3, 3, and 2, and their PEPY runs about $8,000? That's the reality, because I'm giving you the history. Looking in the rearview mirror, I'm telling you what this local market in the 50 to 100 lives did. So forget what somebody else is telling about the market's going to do, what their forecast is. Let me show you 3 years of history, and and the CFO is going to know his last 3 years of cost. And you'll have to help in one way. What did you spend in healthcare last year? $4 million. How many employees do you have? 4,000. Hey, you're spending $10,000 PEPY. That's the simple arithmetic. Okay. But reality is your peers are spending 8 and they're not going up 6 to 8% a year. So deal with facts. It's good to deal with the last 3 years of history, because BS history.
I know something we don't do is, and I see Craig do it. Craig had something come up, so he couldn't join us today, but doing projections over 5 years, cost of inaction is one slide he likes to use, is versus looking at it on a 1 year basis, 5 years. I know from an owner standpoint, we're looking out, we own a company, 5 years, 10 years. That's the story of the Achieve Consortium sale. It's a long-term play. Is the CFO looking out that long? Do they want to look at a pro forma that looks like that, or is that maybe a waste of time?
I'd do 2 things, John. I would look out. I would take the example I just gave you. You're spending $4 million a year. And let's say you're used to it going up 6 or 7% per year. So you do your math, that $4 million turns into almost $5 million in 3 years. It's $1 million more of cost. You can't charge more for it. What if, and let's go back to, we're taking your 4 million example right now, and you're saying you went up 6 to 7% each of the last 3 years. So that means 3 years ago, it was, I'm making up a number, $3.2 million. So we're already gone up 800,000. And I just shared with you the facts that had you been upper quartile, your $3.2 million would probably still be $3.2 million. So without any hocus pocus forecast, you're already $800,000 over best practices in the last 3 years. And left to your own devices, all other things being equal, you're going to increase on your numbers another $1 million. So you're going to go from $800,000, over par in golf terms to being $1.8 million over par by doing the same thing, which is the definition of insanity.
Gotcha.
And I'd stop there and let him ask questions.
I have a question here. What are the top 5 key performance indicators at every CFO, regardless of the economy?
Was this like a graduate school test? I got to think about this one for a second.
Well, give me maybe not the top 5, but give me some of them.
How much cash do I have? What's my cash burn rate in a bad economy and a normal economy? So right now, everybody's looking at, do I have enough cash to survive 60 days?
Tell them what that means, cash burn rate.
How much money do I have in the bank and absolutely certain coming in? So good receivables from viable customers. So let's say I've got $1 million in the bank and I know I've got $1 million that I'm going to receive. I've got another $1 million at risk. So right now I've got $2 million, and cash burn is, for paying my mortgage, for paying my insurances, for paying my key employees, which are executives and key employees. How much is that per week? And how many weeks do I have of security? Because that's going to determine if I bring all my factory workers back, if I do a 25% pay cut, if I radically change healthcare insurance to 50-50, that the employees pay half of the premium. So first of all, I have to understand my cash position and what it means in my worst case and my average case. Forget best case. Best case went down the tubes in the last 12 weeks. Second point would be, what does your backlog look like? How much business do you have in the factory that you can work on for the next 6, 8, 10, 12, 14 weeks? If you only have 4 weeks of backlog, there's no sense opening your factory, because in 4 weeks, you're going to shut it down again. So cash, backlog, they're probably worried about what the marketplace looks like. Do you have purchase orders waiting to be signed? Are you confident that you might have 4 weeks of backlog in that example, but there's customers out there going back to work that have to replenish their inventory and order from you? So are your key salespeople talking to the customers that are going back to work that you have current data? I think right now you got to survive those 3 questions. I can't do 5.
One says, what is the best way to reduce medical procedures that deliver no value, like back surgery, many knee and hip replacements? I would answer that by saying creating some sort of process that requires a second opinion on them in order to have them process through. If it's just as easy as writing up a script, you're going to have trouble. Setting some sort of pre-authorization. You could require specific facilities. If you look at a company like Edison Health, Tom Emmerich's company, he puts it in a plan document that they must go to this specific facility for back surgery. I mean, they got to get on a plane. They got to go there, because those facilities don't do unnecessary surgeries. They're going to do everything they can not to do the surgery. So that would be my advice on that, to kind of minimize that situation. So we got a question here. If the upper quartile trend is 0 to 2%, why are we seeing national survey results indicating that 8% average, Kaiser, et cetera? What research is available that supports your claim of 2% for the upper quartile? It'd be helpful to back up that statement with independent research. Thank you. I don't know if that was a question or from
Shoot,
Cliff.
it's even better if you can just say that your clients are running that way.
Well, that's what I was going to say, is you have enough sample size in your house, maybe not just your clients, but look at your peers or look at this group and just band out 50 to 100 lives and 100 to 200 lives. And maybe you put a little revenue number around it and create your own data.
Yeah, I think the benchmarks work when they work in your favor. I'm not a huge fan of benchmarks, but when they're in your favor, be sure to use them, because you could have a PPY of your existing clients of certain sizes, and I don't care if you make the numbers up, because it varies so much from a standpoint of conversion factor. If you don't know what that is, that means basically for every employee how many dependents are on. So at a 2-point conversion factor, it means if you got 50 employees, that means there's 50 employees and 50 dependents. So it's 100 total belly buttons. Got a question from Rich Scarborough. What would be a question asked in a cold call you've never talked to that person, or in an initial meeting that would get your attention to respond to the question?
Well, I'll use the example we had, John, 3-4 years ago with you. It was all about analysis. Do you understand what costs affect your healthcare? Do you understand what you're paying for in premiums and claims? Can I break it? Can I take a few minutes of your time, not selling to you, educating to you, because most brokers will not share the information that they have about you or your account. And I want to work with you as an advisor, not as a broker. So I'd like to start with some education. And then you start with exactly this. I'm going to assume you know everything about every line item on your P&L except healthcare. You can do a variance analysis on freight, on overtime, on material costs, on discounts, on receivables and write-offs, but can you show me the analysis that drives your healthcare expense? And so you've got your second or third largest line item. You're flying in the dark, trusting your broker, and that's not the way I work. I share information.
Perfect.
I would take that meeting.
Jeff Seeley, what would your approach be with a CFO who's with a cash flush organization, even with a high per employee per year cost, struggling industries, nonprofits easy, but the conversation seems to be very different in organizations with strong balance sheets? So, yeah, I mean, I had that situation where the company's just cash rich and they don't really have to do much. Bad prospect.
Yeah. I mean, they still. That's a great question. I'll tell you, I haven't been in that situation in 20 years. I used to work for a sin industry in cigarette business where we had a lot of money. After that, I'm back to competing for a living. Even if they're cash rich, you still come down to, do you have the right plan for your employees to recruit and retain employees, and that gives employees good coverage without costing them a lot of money. Because I'm struggling with who's cash rich and has a great plan, who's not a teachers union, a state employee, etc. So if you throw out the outliers, there aren't many companies that are ignoring the rising cost of healthcare. I mean, I think the short answer is healthcare has gone up 6 to 8% per year on the survey. Have your unit prices gone up 6 to 8%? Have your salaries gone up 6 to 8%? And the answer is no. We've had to cut back on salary increases because of the cost of healthcare. We would rather, so then take that train of thought. Would you rather give $1,000 more to your employees to pay them, or would you rather give $1,000 more to Aetna?
Yeah, I had a situation
you
with.
You still have that choice, even if you're cash rich. The CFO still has to make a choice how he's going to spend the money.
Yeah, it's not going to be a motivated buyer. That's the reality. But we had a situation with a group up in Paul's neck of the woods, Silicon Valley, and they had tons of money. It's like, John, let me explain to you. I am not trying to save money on healthcare. I don't need to save money on healthcare. What I'm interested in is finding money to utilize for other things that I want, like daycare at the facility, extra or curricular stuff to keep the employees here so they continue to work here, and don't leave and go home. So those were some of the things that they had mentioned. So you just got to figure out, Jeff, maybe what they're looking to do here.
John, let me hitchhike on that idea. You're satisfied with your spend, but you're not satisfied with, are you spending it the best way you can? let's talk about your healthcare spend because it's probably the largest spend in your benefits. To talk about if we freed up $5,000 per employee, call it $1 million a year. Would you offer that as a way to, if you elect this plan or if we make this change, we'll pay down $5,000 of your student debt every year? Or daycare, $5,000 for daycare. Start to throw out some brainstorming ideas because his typical broker isn't going to talk to him that way.
I'm going to bring Paul on for a second. So,
Okay.
Paul, you're having these conversations right now with the CFOs. Talk to me briefly about what your opening words are. We had that question actually from an advisor today.
Yep.
Kind of your opening talk with them.
Well, it's a great kind of segue from what Gary was talking about, the fact that all the things that he's saying he wants to hear are the things that we have, the questions that conversations with guys like Gary is how we built our scripting and figured out, okay, what do they care about? Once you know what they care about and what motivates them, then you build your scripting around that. So I'll tell you in a second if you want me to answer the question you just asked, but so I don't forget, I want to jump ahead to what happens when they push back. You're going to get 3 of them on the phone for a certain number of dials, and one of them is going to say no so fast you don't get to say anything. One of them is going to say yes so fast you don't have to say much. And then one of them is going to push back. And when they push back, our messaging is, hey, look, all the folks that started our company used to work for national insurance companies. And what they saw was that they had way better programs and pricing for large employers than they did for small employers. So they started this firm to change that and bring those solutions to you. As a result, while the rest of the market is paying $15,000 per employee per year on average for healthcare, our clients are paying half that. That's what I want to talk to you about. I want to show you real life examples of how we've done that for firms your size. And that's like a practical application of exactly what Gary was just talking about. And the results are that people like Gary say, I'll take that meeting. I mean, we get them laughing. Sometimes they're like, all right, I got to take that. I want to talk to you about that.
Perfect. Hey, try to turn your camera on now. I'm not sure if it'll work. Craig just joined us. Craig, are you there?
Yes, sir.
Thoughts? Were you able to hear what we were talking about? Gary, if you could try, guys, could you try to put your cameras on? Let me know.
Yeah, I just heard Paul. And, he's absolutely right. I've said many times.
There we go.
Sound like is who you get delegated to. So sound like somebody who knows how to talk to a C-suite, CFO, and they will engage you. They are happy to engage you. My God, they want to talk about anything but health insurance. So tomato, health insurance leads directly to working capital, cash flow, earnings, annually recurring revenue. And that leads to job security and significance to the CFO. So if you can speak to them in their world, either he or she is going to welcome a conversation with you. And then later when they find out you're talking about healthcare, they do not blow you off because they're engaged.
Perfect.
That's simple.
Real quick comment on that, John, on what Craig said. Half of the appointments that get booked, and I'm talking about a lot of data here, half of the appointments that get booked, the word healthcare is never mentioned. Nothing about plan designs or self-funding or anything. None of that is part of the conversation. It's all about finance, the topic of finance and how they're managing it.
If you guys have questions for Paul, go ahead and put them in the chat here to the right. Gary, are you there? I have you on
think
mute.
I am.
Okay. You are here. See if you can get your
You've
camera
never
to
looked better.
Yeah, see if you can get your camera to on in the bottom left for us. You see that handsome
Can't
face.
figure it out.
So Craig actually, let's see what he said. Craig asked, are the banks looking to stick in business that need more working capital? Would it be of interest to find industry working capital in their OPEX?
That would be hell right.
Yeah.
Yeah. Why do you have to go to the bank and pay interest on your money for new working capital lines of credit because your revenue sucks? Your cash flow is dangerously low. You're flowing around dollar bills like they're manhole covers. If you don't live in an area where a manhole cover is, look it up. Because some of you people live in strange places, man. I don't understand. I'm a city boy. So if you could show a CFO, look, you got money that you can loan to yourself interest rate free. Shouldn't you start there? It costs less money. That's a provocative conversation. Gary, what do you say?
You are the best at it. Now you learn from me every time, Craig. You can't see my camera, but I'm smiling. Okay. It's exactly those words. Use Craig's words. You're paying, 15% of your total costs are in healthcare, and you don't manage it. You're sitting on costs. Nobody shows you how to do it. I'll show you how to unlock it. It's your money. Right, Craig?
Yeah, it is your money. And why would you piss it away and give it to an insurance company recklessly? I call it financial infidelity. It's worse than marriage infidelity. You're losing money because you're a dumbass.
Well, Craig, if I can jump in, a couple of years ago, maybe 8 years ago, I launched a healthcare renewal meeting with our 200 employees in one room. And I started it off by saying, I'm here to talk today about the fact that we no longer have healthcare insurance for our company. Pizza slices hit the table. The bullshit stopped. And I said, let's understand. And the broker is sitting next to me. It's not young John sitting next to me. It's a broker who still hates to hear my name. And he basically said, I said, we pay this firm $2 million a year to pay our claims. And then we pay them 15% for their overhead and like a 20% margin that the state of Pennsylvania allows them to charge. And if you have more claims than that by eating cheesesteaks, not exercising, drinking too much beer, they add it next year's bill and they add the 15% and 20% to it. We do not have health care. These people are an accounting service. They're not here to lower our costs. And then I turned it over to him.
Nice. Yes, they are. They provide an accounting function.
But if you explained it to a CFO like that, do you understand how insurance works? We understand what drives your costs, the reserves, and the way insurance commissioners, et cetera, set up this monopoly. Why don't I explain that to you? Because there's no other cost in your P&L that is managed like this. And just you talk to a CFO. You can get a tax advisor who can help you lower your federal and state income taxes, but your broker won't help you lower your healthcare costs because his goals are not aligned with yours. My goals are. I'm an advisor.
Let me jump in for a second. Gary, you should be able to turn your camera on now. I had to make everybody a co-host. I figured this out. You would think I'd know.
Oh boy, it wasn't my fault after all.
So, he just mentioned, talking about a tax guy and advisor versus broker. And I think the good example is, and we talked about it at High Stakes Advising last year, was talking about an accountant, a CPA versus a tax strategist. Mm-hmm. And the two are very different, right? One does your taxes, call him a historian, file your taxes, no tax strategy, no advice, know how to really, maybe they know about some deductions, so on and so forth, but that's about it. Now, a tax strategist is going to tell you all the loopholes in the tax code to use to your benefit, because if you didn't see the Facebook Live with Tom Wheelwright, CPA of Robert Kiyosaki, who wrote Rich Dad, Poor Dad, he talked about them all. Pick up his book. He talks about the different strategies that the government gives you to cut your taxes down. 95% of the code is written to save money on taxes. So not many people are talking about it. It's like, well, why is nobody telling me this? So when you differentiate yourself as a broker, and you've got a broker, and that's great, but I do consulting work, kind of like a tax strategist, parlay into that conversation of a CPA and a tax strategist. People hire me to find the money and give them ideas how to save money outside of what they're currently doing. It doesn't require change. I got a call yesterday from a guy I spoke at a year and a half ago at one of Gary's events, and a guy called me, owner. 3 to 5 minutes in the conversation, I asked my typical questions, just kind of qualifying him on the fact of, can I actually help the guy? I think it was a smaller group, 40 plus lives. And, he said, I'll send you my census. I go, well, let me explain to you how we work first. And I gave him the talk on the consulting role. I said, listen, you're a little further out from renewal. I'm not going to ask you to change your broker, but what you're asking for me is some ideas to provide you with ideas. Is that what I'm hearing? You want to know what else is out there? Well, great. I charge people $5,000 for the consulting to provide those ideas for you because you're part of Gary's group. It's $2,500. You send me a check for $2,500. I'll give you some great ideas. If you're unhappy with them, I'll give you your check back. Okay. And then after we go through those ideas, if you like them, you have another decision to make. You can, hire me to help you implement them next to your broker, or you can hire me to take over the whole thing, or you could take it with your broker and just do it yourself. That's up to you. And I mean, I think it was 6 or 7 minutes. I looked into the call and he said, okay, that sounds good. Send me over the invoice. Like that, right? I'm getting paid just by you just sounding different, offering something different. Again, we talked about it at High Stakes Advising last year is asking somebody to marry you without dating you first. This allows me to date him. He's paying me and he can keep his wife and he can date me, right? That's I look at. He could date me and see if he likes me first before he leaves his wife, right? Might sound crazy, but that's the reality of what's going on, okay? And now it creates an opportunity for me to show my expertise to where before they're backing up and is this guy lying to me? Is he not? He's saying this to get my business. What do I do? The only way he's going to get my business if I do what he says. He could be lying. Well, I take that out and I become unbiased because it's just matter of fact as far as here's what I found. Here's what you should do. Here you go. Good luck.
Let me interject real quick, John. So I've always called that, would you rather audition for free or get paid to audition? So you talk about, and Gary can attest to this, a lot of CFOs at companies that are your prospects worked for the CPA firm that did their audit work. So I think all of you guys are nuts to not develop a relationship with a tier 1, tier 2, or a regional CPA firm because they're all broken down into 3 functions. Like John was saying, most independent small CPA firms are either historians or tax planners. And most of them are historians, just like there's brokers versus consultants, kind of, sort of. CPA is really simple. They do tax work, they do audit, they do advisory. So I had conversations with 2 of the big 4 accounting firms and say, how do you differentiate your advisory versus somebody else's? Do you have to have a world famous, world renowned, CPA who speaks, who talks, who writes, because at the end of the day, don't you all have the same things? It's based on very specific individuals' unique insights, and that's how they differentiate. Well, in the absence of that, for a tier 2 CPA firm who's doing tax, audit, commodities, advisory, how do you differentiate against your competitors who are much bigger, who have the perception of having many more resources available to you? What if you could do this? Would that help you differentiate so you have a different story? CPAs will like that. Just find the right ones because they turn into CFOs a lot of time, don't they, Gary?
Hey, Gary, you got to unmute yourself there.
We have to train them to be CFOs because they've been looking in the rear view mirror for 10 or 15 years. But you're exactly right.
Tyler says, Gary, what's common mistakes you've seen in the first meeting presentations?
Too much data. Come in with 3 alternatives, 4 alternatives. If they're not currently partially self-insured, but don't bring in, a $3,000 deductible, a $4,000 deductible, from Aetna, Blue Cross, Capital. They're all about the same. We all know that. Show them, their current plan if they renew it. Here's the closest thing to what you have. This is what it looks like. And when we show you the alternatives that will reduce your costs and reduce your employees' costs. So we're going to look at it 2 ways. What's better for the employees, what's better for the company. And that's very, very important because the CFO has to be reminded that they have a fiduciary responsibility to spend the employees' contributions, what comes out of their paycheck and their copay and deductible. They have to be reminded that they can be sued personally. It's very important. I'll repeat it. A CFO can be held personally responsible, not protected by directors and officers insurance if they fail to act in a fiduciary manner. Most people know about this from 401k fees, but healthcare costs are such a big part of the employees' deductions for take-home pay and their cash at the end of the month, that the CFO has to be reminded, as much as you're the steward for the company's money, you're also the steward for the employees' money. Let me show you how we can accomplish both in a win-win. And no other broker will tell them that.
I like to go in with one main strategy and one backup. Shit hits the fan. I have a backup plan, you know.
But John, when you come in with us, you've got multiple alternatives and you have 10 throwaways because they're terrible options. Don't show me the terrible ones. I'm paying you to call those out. Show me, if we do this, here's a recommendation I'm very, very comfortable with that I would recommend to you. And then here's one that's slightly more aggressive for the following reasons, taking a little more risk, but saving 3 or 4% more per year. And we can self-insure against that risk. So let me take you down those 2 steps, but no more than 3 pieces of paper. I'm not that smart.
One question was, what's the quickest way to change the CFO's mindset from a softy, fully insured plan to unknown self-funding?
First of all,
he's got it asked backwards.
Fully
Fully insured is unknown. Self-funded is known. John, we got to publish our 28 reasons why, if you think fully insured is less risky. Read this.
Please do.
You can't have it, Gary.
I'll have to buy it.
I don't want you to hurt yourself.
If you're talking self-funding on that call or that, I mean, it's a little early for that. I'd say.
Yeah, I think I'm not one to just say, hey, listen, don't talk about it. I think you can talk about it all you want. But you have to explain it in a manner that it's partially self-funded. You're still buying insurance. You have a deductible of $2,500. Great. We're just raising the cap on it. Okay. You're taking a little bit more risk up to a cap, just like you have now, and buying over it. It looks and smells just like what you have now is what I tell them.
If I can jump in, Paul, let me bridge from not bringing it up to going back to when I said, what are the best-in-class CFOs seeing? What are the upper quartiles seeing? They're doing partially self-funded. And that is the best practice. And you can manage it. You can manage the risk. You can understand it. You can control it. And you can serve all your masters by being partially self-funded. So you don't have to be afraid of it. It's a means to be upper quartile and reduce your risk and control your costs.
Yeah, I guess what I'm saying is I think it gets mislabeled. And tell me what you think about this, Gary, because when I'm talking to CFOs, I'm letting them know that we would never suggest an arrangement that doesn't have a guaranteed maximum cost. They're just going to get a lot more transparency and control. They want certainty, they want control, they want transparency. They have none of those now.
So let's build off that comment. When you're partially self-insured for the first time, somebody with 50 to 100 lives can understand their costs. Right now, you're being sold a bill of goods by your broker. Think about it. You pay a bill every month and don't see your costs. And then you get 15 minutes of bullshit from somebody once a year, and you don't see them for 11 more months.
Exactly.
Any other supplier you would tolerate to do that. And oh, by the way, you have to go home and explain to your wife, well, your coverage got worse the next year.
Yeah, and I'm not suggesting we don't talk about self-funding. What I'm saying is we've mislabeled it. They're not. This 200 life case isn't going to be self-funding everything. They're not taking on the entire risk. That would be crazy. We would never design a plan that doesn't have a guaranteed max cost.
Yeah. Tyler's follow-up was, John and Paul, how have you changed your approach over the years? I would start by saying, I've changed it significantly. I was doing everything, probably a lot of stuff wrong, talking too much about healthcare. Obviously, I give a lot of credit to Craig. Probably that's when it really changed for me. I realized, what the F am I doing? I sound like every other broker. Yeah, I had minimal success and I did well. And I started with self-funding, and that was kind of my differentiator. But outside of that, I sounded pretty similar to everybody else, not knowing it until I joined a group and kind of heard it from Craig. But I started asking better questions. I started talking more about their business and just looking for ways to turn it into conversations into healthcare. Healthcare supply chain, it's beat to death online now. Those that don't know, Craig made it up couple years ago. That was one that he taught me just how to segue the conversation to that. Talking about the consulting role has been a big change. I can most of you have enough experience out there where you can feel it in the beginning of the meeting. Is this going to be an opportunity for broker record? Are they unhappy? Are they happy? Well, then I'll just shift the conversation of where I'm going to the consulting role and just let them know right away, hey, I'm not looking to get anybody fired. This is how I work, and try to get them to back off a little bit and not be afraid to tell me anything like they usually are when you're asking them to fire their broker. So that's kind of how I've changed. Paul?
The biggest change, our sale was always, it was a lot clunkier and it wasn't as eloquent, but we were always going in, and then that worked because we were in smaller group at first, but we were going in saying, we're going to address the real problem, and the real problem is cost and quality. We're going to get you better quality and lower your cost, which is what everybody wants. You want to fly first class, you want to pay Southwest prices. And that was our pitch, which worked fine for small group, and we did it all for free. We got them to shake hands and say, if we can do this for you like we've done it for other companies, we want your commitment, owner, that you're going to give us the business and hire us. And most of them would be true to their word, and we'd grow the business that way. The biggest problem with that, there was two. One was it was a pitch that worked small group, it wasn't CFO oriented for large group, because these groups didn't have CFOs, to Gary's point from earlier in this event here, that we could access the owner. The owner crawled out from under a car that he was wrenching on or something, right? These were small groups. But the other problem was I had to have my back office working around the clock, pumping out proposals for a ton of deals that we did not win. So after I met you guys and took this Trojan horse thing to heart, and then with these solutions where we can actually manage claims, then I watched my back end, the workload go down 90% because we stopped doing anything for free. I mean, it's just amazing. When you operate as a peer and you speak their language and they respect you and they have confidence that you're going to deliver results, and you create a frictionless sales process that you've talked about with this Trojan horse sale, they're going to agree to that easy next step. They're not firing anybody.
You get
they get
more
to
respect.
find out. Yeah,
you get more respect.
Why would I do it for free? I mean, my perceived value when I'm doing a bunch of work for free is not that high. So, I mean, it's just incredible.
And Paul, if I can comment on that, we absolutely understand that. We don't want our sales guys or BD people doing work for free. So we respect that.
Right.
To John's point, he gives my buddies, my referrals, a discount, but he gives them a performance guarantee. And none of them are going to ask for their money back, because they realize he's going to put a lot of time into that work for $2,500. You're probably charging him $50 an hour, and you're worth $5.
No. I'm doing it a lot faster than you think. I got it templated down, baby. Don't tell anybody.
I'm trying to put you. You're killing yourself on that one. I was trying to. My point is, all kidding aside, I don't have any of that cost information to do that analysis. So the fact that you're giving me a way to analyze it in your template is priceless to me. Keep in mind, I'm getting bullshit from brokers. I'm getting general market information. 30% of your costs are going to pharmaceuticals, and everybody's on Celebrex, and they're going up 15% per year. Show me my data. I've used this analogy before, and see if you guys see how you would react. I had a broker giving me that crap one year, and I said, by the way, give me my information. Oh, it's HIPAA, sir. It's HIPAA protected. Yeah. Here's my 6-digit HIPAA number. I am HIPAA certified. Give me my damn data. It's mine. And by the way, Mr. Broker, are you HIPAA certified? My company is. Are you and I literally got up in their face across the little conference table and said, get the hell out of my office if you're looking at my employees' data and you're not HIPAA certified. Leave. Never come back. Give me your boss's name. I want to talk to your compliance officer. You have my employees' data. That's private data. You're jeopardizing my career. Get the hell out of my office. I did that with Capital Blue Cross in Pennsylvania. I got a call from the senior vice president in Harrisburg. I said, I'm calling the insurance commissioner. Your sales guys have data, and they're not HIPAA certified to have it.
There you go. That's why I love them.
It costs me $25 a year to be HIPAA certified. It's the best practice we offer to our CFOs. It scares the hell out of you guys when the customer's HIPAA certified and you're not.
Guys, we offer Chief Health Plan, our administrator, offers HIPAA training that we're going to be doing for the CFOs, HR people, and offering it to them. If you guys are interested in that, we can get them on. Is my camera showing when I'm talking or no?
Yeah.
It is?
Yes.
Okay. It's looking different on my end.
Hey, Gary, do you like flat fee or a percentage of savings or commissions? Do you have a personal bias on how you prefer to pay somebody? Like
Not
the health insurance?
commissions. I'll do flat fee. I'll do transparent. Whatever's transparent for you. I'll do flat fee or I'll do percent of savings. Most of my peers will prefer flat fee because they don't trust you guys. I know two. I don't know Paul yet, but I trust the other two.
I see a lot of that.
Pay for performance models work really well with CFOs.
So you
Especially
like,
if you're going to show them your cost data. If you're going to show them your cost data, the upper quartile data, just give us data. We'll believe you.
Cliff says, what size prospect employee count does this work with? Any size. I've done consulting role. I've done on groups, 30 lives, and I've done them up to 1,000 lives. And I've done them by the phone. People that I've never met, never thought that would happen, but I've done it. And biggest account that I got was 1,000 lives, and it was done by the phone. Johnny Sacco. Does it make sense to suggest that an employer reduce the employee contribution when the maximum cost of moving to self-funded is slightly higher than their fully insured renewal? Ooh, I like that. So basically, if I come in at $1.1 million and you're at $1 million fully insured, but on the self-funded plan we can get up to $600,000 back, does it make sense to employer reduce the employee contribution? Okay. Yeah. So keep it flat, I think he's saying, versus increase it to the 1.1.
I'll throw in an option for you, John. Keep it flat, but keep it flat for at least 2 years.
Okay.
So that's like not jacking up their contribution 2 years in a row. Just make the commitment internally, the CFO to the rest of the management team. We're changing our plan. We're taking a little bit of risk, but we can control it. And in return, we're going to hold the employees' costs flat for 2 years, and we're going to tell them tomorrow.
Yeah, I think, and I got to tell my one client, they keep increasing, even at, we're going up 3 to 5% on a self-funded health plan, but most of it's the attachment point. So you got 1% on fixed costs and 4% on attachment point that they're never going to hit, but they're asking the employees for a bump. And to fight them last year. I'm just going to tell them this year, the reality is if you're going to bump them up, you should be giving them money back if you do well, because that's the play. Instead of taking it from them, you just take the risk and you get the reward because they've been winning thus far. So,
Hey, can I ask you a question, Gary?
Yeah.
Follow the math. I know you'll appreciate this because it's numbers. Revenue comes into a company. That company has choices. You can provide payroll, the most expensive money there is because of workers' comp and FICA taxes.
Mm-hmm.
And very high 90+% of the country works and earns far less than the Medicare max wage.
Absolutely.
So you're deciding, do I give, say, top quartile of wages to be competitive? And then I have employee benefits. I arbitrarily and capriciously determine what percentage I'm going to say is employee contribution. In fact, it started as revenue. I've arbitrarily determined that some of the revenue I give you, employee, I'm taking back as an employee contribution, which, fascinatingly enough, under cafeteria plan section 1.125 regs, as soon as the employee takes the money out of their payroll pre-tax, instantaneously becomes an employer contribution per the law. So why do companies not provide 100% employee benefit or a significantly higher portion of employee benefit, which is a tax-free, income tax-free perk to the employee worth 1.4 of taxable wages instead of this insane, I'm going to charge them 50%, 25%, and then have to drive up my cost for wages because my benefits are just, why wouldn't you put downward pressure on the wages you have to pay people and give them unfreaking believable tax-free income perks?
Smart CFOs understand that math, Craig.
Yeah.
Okay, we'll make you a CFO yet, but you get it. Okay. The interesting part is most CFOs don't understand that, and you have to find a way to make that point. It's really hard to make to somebody who doesn't get it. Okay. The way we do it is when we're recruiting, we really talk up our benefits because as a result of working with John, we eliminated our deductible for employees last year, 2 years ago.
Shut up. That's awesome.
Yeah. But we're in New Jersey, so the family deductible was $6,000. We eliminated the deductible.
Nice.
John knows the story. We renewed December 1st. Our first year savings were over 25%. John, my partner and I own the company. We actually got a dividend check, something I had never seen from a healthcare company. We got a dividend check, and we said not only are we saving roughly $100,000 of our money as owners, we just got a $12,000 or $15,000 dividend check. What the hell do we do with this? It's almost like we have to figure out how to book the accounting because we got money back.
Yeah.
And we said, hey, John, how much if we bought down our deductible? And it was, I don't know, $40,000, whatever the hell the number was. And for our headquarters staff, and we did that. We announced it December 1st. Shortest renewal John's ever done. 5 minutes with our employee group. And so this is great. We have no increase. And we reduced our deductible. We got this teledoc thing, which works. And John's office is open 24/7. Why are you still here? And John was standing around. I guess I should leave. 5 minutes of good news. Leave. And in the next 3 weeks, we had representatives of each of our functions come to one of the owners, me or my partner, also named John, and said, this is so generous. We would be fine if you eliminated the cost of living salary increase on January 1st. So we spent $50,000 on deductible to buy it down, to eliminate deductible. We eliminated, and we took a little bit of risk. So call it $75,000. We eliminated $300,000 of salary increase, which the following year would have gone up by another 3 or 4%. So we built an annuity model, and we eliminated all of our recruiters because that became our recruiting model. That you basically, whatever you pay per week is your healthcare cost for this.
So fair to say, if you have fantastic health benefits, you don't have to pay the top wages to be competitive. That's expensive money. Is that correct?
Absolutely. And the interesting
brokers need to be talking about improve the benefits.
We're a small engineering company in New York City.
Yeah.
Okay, based in New Jersey. All of our customers knew about it within weeks. And two of the top industry professionals we were trying to recruit for 2 years called us up and said, is the job offer still open? I only wanted to hire one of them. I hired both so I could cripple 2 competitors.
Hey guys, if anybody wants to jump on, just raise your hand here, and I think I can click allow you to talk if you want to ask a question verbally here. Like I said, next time we'll try to do it through the Zoom meeting. Spencer Gold said, "Is that AKA grossing up payroll, Craig?"
No, knucklehead. Your payroll's your payroll. Give more of it as an employer contribution towards the employee benefits because it's an income tax-free perk to the employees and charge them less money. Very simple. Now on all your future hires, when you're rehiring these people that have been furloughed, fired, or terminated post-COVID, knowing most employers aren't going to probably return to the same full-time equivalents they had before, change the formula. There's going to be 10 unemployed for every job. Give them freaking kick-ass benefits, and you don't have to pay as high a wage to get them to join your company. Simple.
Would they pay less in payroll taxes from that or no?
Sure.
Lower payroll, less payroll tax.
9%, 8, 9, 10% lower taxes.
Wow. All right, guys. Final thoughts here as we start to wrap it up. Gary, if you want to just kind of give an overview of some of the things you'll talk about. Those that don't know, high stakes advising is going on in California, Huntington Beach area, August 2nd and 3rd, a Monday and Tuesday. Paul Siegert's going to be joining us there. He's going to teach you how to book 50 to 100 meetings a year. He's going to lay out his step-by-step process. He's going to give you the scripts, his automation, emails, calls, everything. He's going to roll it out to you. Gary's going to be talking about how to set up a CFO group that I've made north to six figures from on his group. Thank you, Gary. But just, Gary, talk to you a little bit about what you're going to talk about setting it up and things like that.
Well, we have a CFO. We have a CFO group, and we have a virtual group. We have the Pennsylvania group. We have the New Jersey group, and we share best practices among peers. What are your peers doing? And we've got over 1,000 best practices. And one of our 6 power chapters is how to reduce healthcare costs and how to reduce the total cost of healthcare and improve plan quality at the same time. And nobody believes it, so we have a chapter of best practices, whether it's 20-person lives, whether it's a one-man consulting company, or whether it's 1,000 life that can bring in some kick-ass offerings that Craig's created. But we offer those, and we basically have 40 to 50 CFOs who meet monthly. They pick the topics. I bring in smart speakers, and we manage the meetings to drive discussions, and then we document the best practices, put them on our website, thecfosolution.org, and we serve as Google for Dummies for private company CFOs. And the question we had earlier was, a third of us are responsible for HR and have no training in it. Another third are held accountable for when HR screws up healthcare. And so we went to school for accounting and finance, not healthcare and compliance and HIPAA and hiring and firing. So 80% of our conversations at the CFO forum groups are not on finance and accounting, but the other stuff that will get you fired if you screw it up.
So if I understand you correctly, Gary, we're going to share in August, if you show up, we're going to share with you how to set up your own CFO group in your locale, your region, so that you can truly be different.
Yep.
Print
add
money.
value before you ask for something by giving controllers and CFOs and VPs of finance value in exchange for, eventually they'll say, gee, what else do you do, Paul?
Yeah.
And you're going to get new business. Now, let me interject. For those of you who've stayed on this long, let's give you a reward. I'm going to bring some of my friends. They've got $1 million, $2 million, $4 million, $10 million plus books of business. You might be able to learn something from them. So get out your checkbook, have some balls, invest in yourself, and show up, because the weather is bitching in Orange County in August, and it pretty much sucks where most of you guys are. So come to Cali. We'll party on the Sunday before, and you will learn enough to save your whole $2,000 that you're going to have to invest in yourself, or whatever the hell it is. Okay? Guys, gals, get to California in August. It's not going to be, there's not an unlimited presence. We're going to cut it off, and once we do, you get nothing. So come on out. You don't know too many people who have $4 million and $10 million plus books of business, but I do. And they're going to talk to you. They'll be available to answer questions.
Oh, yeah. A
They
guy
have
by
some
the name of
interesting insight.
Jordan Belfort, Wolf of Wall Street, will be there too, by the way. Let's not forget about him. If you can't learn from him, you're in trouble.
Yeah.
Bill Hughes got his hand up here. Go ahead, Bill. Let me see here. Let me unmute you.
He talks funny.
Texas boy. Go ahead, Bill.
I do talk funny.
Howdy. Howdy.
So what I want to know is, how in the world did you get Gary Bender to come on tonight? No.
Pictures. He saved me a lot of money.
Save you. Hey, Gary, that's good. So I had a CFO on today, and his biggest concern was, I guess, the disruption. And I'm just really trying to rethink that conversation a little bit. He had been on a plan that had reference-based pricing.
Oh.
and they weren't happy with that. Obviously, you know, what we're doing is something different than that. But so just kind of rethinking that conversation a little bit. You know, of course, I let him know how what we're doing is different. But if you're a CFO, how do you see disruption? What is it? How do you view that?
Well, I'm an oddball. I see it as an opportunity. I'll tell you right now, I'm an extroverted. I love change. I love disruption. Disruption is opportunity for me. So I'm not your typical CFO. I'm not paranoid. I'm not afraid. So I can't help you there.
What do you see as, because Gary deals with this in the group, because Gary, you know, Gary runs his group. He'll bring in guys like me and I'll start screaming at him like, what in the hell are you guys doing? I keep telling you about this and nobody's moving their ass. I see the emails he sends out. I mean, he literally gives it to them, and, you know, some of them just build, some of them just won't budge. You know, they're scared. Things are good, and there's not enough urgency for change. And I think maybe there'll be opportunities now. Now, I think that's going to be a bad example, that prospect, because his ass hurts now from RBP. Number one reason brokers get fired, by the way.
Exactly.
So be careful with that.
Let me give you a quick story, John. Bill, this is how you do it if you're prepared, buddy. I was just talking to Amex this week, okay, a division of American Express. I started off the conversation with, are you concerned about China going cashless? They're like, what are you talking about? I said, well, you got 800 million people use WeChat, Alipay, and UnionPay to pay their bills. When they leave the house, they don't have wallets. They don't even have to carry their cell phones anymore, because all they do is look into a screen and it pays their bill. Do you expect that to come to the United States? And if it does, what's the impact on American Express cards in your wallet? And they went, we're not expecting any of that, right? But we got an engagement as to, so when this cat said RBP, you know, you're talking about features and benefits of healthcare. He automatically cares less. What did did you ask him, hey, what did that negative impact on RBP cost you? Did you get the balance bill, and did it happen to be on the CEO's spouse or the number one salesperson? Did you have to write a check? Did you go after you just paint the story, you get him to tell, you get him to share, you get him to, what was the impact? I mean, what would happen if he didn't change? How much was it going to cost you? And so once they tell you that and they engage with you, now you know how to talk to them. But until you get an interaction, you're talking about insurance. You're dead on arrival. You see the difference, Bill?
Absolutely. We did get a next appointment, so we got a chance to stay alive.
You got a second appointment. Just be really prepared next time to not talk about all the cool shit you have in your box, that everybody shows up with their own box. They don't care.
Mm-hmm.
Yeah, most of the presentations look the same. All right, Bill, thanks for joining us.
John, you know, one of my favorite examples is, well, if you're not looking at this change, if you don't want to be an upper quartile CFO, the average tenure of a private company CFO is 27 months.
Ouch.
So which quartile do you want to be in? Because your successor will look at change if you don't think you need to change. Your successor will. I used that a week or two ago, and I got like 20
Amen.
likes, and I can't believe you said that. I said, you think CFOs aren't losing their jobs 6 months from now when the board says, why weren't you prepared for this?
Put a little
And
pressure.
half of them shouldn't lose their job.
Let's go. Let somebody give Gary a mic so we can drop it. That was freaking awesome.
All right, we'll end it there. Hey, Gary, Paul, thanks for joining us. We look forward to hearing you at High Stakes Advising. Guys, go ahead and check it out, headsupadvisor.com. Check out the event. We will see you there. If you haven't, go ahead and join the private Facebook group. We do this every Thursday, 8 p.m. Eastern, 5 p.m. Pacific. It's also replayed on the podcast and YouTube, so everybody can hear it and see it. Thanks for joining us, guys. We'll see you on the next one. Take care. Peace.
All right.
Cheers.
Come on.